Welcome to the deep dive. You know, when most people hear financial reports, they often brace for, well, just a lot of dry numbers.
Yeah, eyes glaze over sometimes.
Exactly. But here's the secret. These aren't just figures. They're dynamic narratives. They really tell stories of growth, challenges, and some pretty sharp strategic moves.
Absolutely. Stories about the direction a company is heading.
And today, we're embarking on a deep dive into the latest financial story of a really key player in India's renewable energy scene, the Indian Renewable Energy Development Agency Limited, or IREDA.
That's right. And our mission today is basically to cut through the noise, distill what's essential from IREDA's latest interim financial statements. We're looking at the quarter ending June 30, 2025.
And comparing it back to June 30, 2024,
Right.
to see the trends.
Exactly. We'll flag the surprising bits, the stuff that really matters for you to understand IREDA's financial health, its future direction. Think of it as a shortcut to getting properly informed about this important public sector company.
Okay, let's unpack this then. Starting right at the top with the auditors, Shiv and Associates. They've given an unqualified opinion.
Which is good news, essentially a clean bill of health.
It confirms the statements give a true and fair view. They follow Indian accounting standards in AS 34 and the Companies Act. Solid foundation.
But, as you hinted, the real juice is often in the details, isn't it?
Always. Where should we look first?
Definitely the emphasis of matter section in the auditor's report. This is where they flag things, critical items that are fully disclosed, mind you, but need your special attention.
Okay, what did they emphasize for IREDA?
Well, one big point is about how they classified certain loans. There was about 418 crores worth.
Down from over 1,200 crores before, which is a big drop.
A very big drop. These were classified as Stage I or standard assets. Now, this was mainly because of interim orders from high courts.
Ah,
Even though technically, under the RBI's own prudential norms, these accounts should have been Stage 3 or non-performing assets NPAs.
so a legal complexity affecting the classification. But how did IREDA handle the risk side of that?
That's the fascinating part. Even with these court orders allowing the standard classification, IREDA was quite prudent. They only recognized interest income on a collection basis.
Meaning only when the cash actually came in.
Precisely. And they still made impairment allowances on these accounts just in case. It shows a conservative approach, which you want to see.
Definitely. Any updates on that situation?
Yes, and this is very recent. On July 2nd, 2025, so just after this reporting period closed,
Okay.
a common court order came through that vacated those interim orders for one specific borrower, a big one, with over 783 crores outstanding.
Wow. So what happens now?
It means that loan has been reclassified back to NPA Stage 3 in the next quarter, Q1 of FY 2025-26.
Yeah.
It just shows how dynamic this legal stuff is and how quickly it hits the books.
That's a huge swing. Really underscores the impact of the legal environment. What else did the auditors flag in that emphasis of matter section?
Another really crucial one is a restatement of their capital to risk-weighted assets ratio, the CRR.
Ah, capital adequacy. Always important for a lender.
Absolutely. So, effective March 31st, 2025, IREDA changed how they weigh certain assets for risk. Commissioned renewable energy projects, ones that are up and running for over a year.
Right.
They now carry a 100% risk weight. Previously, it was only 50%.
Doubling the risk weight. That sounds significant. What did that do to the numbers?
It had a big impact looking back. The CRAR for June 30, 2024 had to be restated downwards quite a bit. It went from 19.52% down to 15.26%.
So applying the new stricter rule retrospectively for comparison.
Exactly. Basically, with a 100% weight, they have to hold double the capital against those assets compared to before. It makes the balance sheet more conservative.
But does it put pressure on their lending capacity?
Well, potentially. But here's the key point.
Yeah.
Even with this stricter rule, their CRAR as of June 30, 2025 is still very healthy at 19.58%.
And how does that break down? Tier 1 and Tier 2?
Tier 1 is 17.7%, Tier 2 is 2.46%, so combined 19.58%.
And the minimum required by the RBI?
That's 15%. So what this means for you is that even after adopting this more cautious approach, they're still comfortably capitalized. Very strong position.
Good to know. Robust capital despite the changes. Were there any sort of procedural notes? Anything under other matters in the audit report?
Just a couple of quick things. They noted the previous year's audit was done by a different firm, a predecessor auditor.
Standard disclosure.
Right. And also that IREDA uses an independent agency for its expected credit loss, or ECL, calculations. That's under IND AS 109.
So getting external validation for those forward-looking loss estimates shows good practice.
Exactly. Commitment to best practices there.
Okay, let's pivot now to the actual financial statements, the numbers themselves. What story do they tell quarter over quarter?
All right, let's look at the balance sheet first. Comparing June 30, 2025 to June 30, 2024.
What's the headline?
Growth. Big growth. Total assets jumped substantially from around 67,000 crores up to over 83,500 crores.
That's a huge increase in just 1 year. Shows significant expansion.
Definitely positions them as an even bigger force in green financing. Their footprint is clearly growing fast.
And digging into assets, the main one must be loans.
Absolutely. Loans, their core financial asset, grew strongly too. From about 62,300 crores to over 78,100 crores.
Directly reflecting that core business of financing renewable projects.
Precisely. And another positive sign, cash and bank balances also saw a nice increase. Combined, they went from roughly 790 crores up to over 12,260 crores.
Suggests strong liquidity, always reassuring for a financial institution.
Very much so. And remember that equity share capital number, we saw a noticeable jump there too.
Ah, yes, from about 2,690 crores to just over 2,800 crores. You said we'd get to the why later.
We will indeed. It's tied to a key strategic move.
Okay, now let's flip to the profit and loss statement for the quarter.
Yeah.
Again, comparing Q1 this year to Q1 last year.
Right. Interest income, which flows directly from that growing loan book we just talked about.
Should be up significantly.
And it is, up from about 1,480 crores to over 9,900 crores.
Makes sense. And total revenue from operations.
Also up nicely, from just over 1,500 crores to over 1,930 crores.
Okay, so revenue is growing strongly. What about profit before tax?
PBT also climbed, from nearly 476 crores up to 518 crores. So, everything looking positive on the growth front, strong top line.
Seems like a clear upward trend. But I sense a but coming.
You sense correctly. Here's where it gets maybe a bit surprising for you listening. The profit for the period, the net profit after tax.
Yes.
It actually showed a dip.
A dip, really? After all that revenue growth?
Yes. It went down from about 384 crores in the June 2024 quarter to just under 330 crores in the June 2025 quarter.
Huh. That is interesting. Any immediate clues why? Despite higher revenue?
The interim report doesn't give a specific breakdown for the quarterly dip, but it could be things like higher impairment allowances kicking in. Remember that conservative approach we discussed?
Right, the provisioning.
Or maybe other operating costs. It's a fascinating point, though, highlighting that revenue growth doesn't always flow straight to the bottom line. Definitely something to keep an eye on.
Absolutely. It shows there are other factors at play. What about total comprehensive income? Did that follow the net profit dip?
Interestingly, no. Total comprehensive income actually remained remarkably stable. It was around 402 crores for both periods.
That adds another layer of complexity. Stable comprehensive income despite a net profit dip.
Okay, so let's try and connect these numbers back to IREDA's actual strategy and operations now.
Good idea. Let's dig into those notes again. Capital management. Notes 38, 23, and 24.
Right. We see a definite improvement in their debt equity ratio. It went down from 5.83 in June 2024 to 5.35 in June 2025.
Lower is generally better, right? Less reliance on debt relative to equity.
Exactly. It shows a healthier leverage position, especially important as the company continues to grow and scale its operations.
And was there a specific reason for that equity base strengthening? You mentioned that jump in share capital earlier.
Yes, absolutely. A major driver was a very strategic move they made in June 2025, a qualified institutional placement, or QIP.
Raising money from large investors. How much did they raise?
They successfully raised just over 2,000 crores. Pretty significant.
How did that work in terms of shares?
They allotted over 121 million new equity shares. This increased the paid-up equity capital by about 121 crores, and importantly, brought in nearly over 870 crores in share premium after deducting the costs of the share issue.
And did that affect the government's holding?
It did, slightly. The government of India's shareholding diluted a bit from 75% down to 71.76%.
So what does this QIP mean for you, the listener, in practical terms?
It's crucial. These funds are vital for boosting IREDA's capital base. It supports their future capital needs and, critically, allows them to do more onward lending into the renewable energy sector.
So directly fueling India's green energy goals by giving them more lending firepower.
Precisely. It lets them grow that loan book without overstretching their capital ratios. Very smart.
Okay, strategic capital raising makes sense. But lending, especially for big infrastructure projects, always carries risk. How does IREDA manage that? Note 38.
They have quite a robust framework. Policies covering credit risk, market risk, liquidity, operational risk, the whole spectrum. And it's overseen at the top level by a board-level risk management committee.
What about specific risks, like currency fluctuations or interest rate changes? They borrow overseas, right?
They do. So they're exposed to foreign currency swings on those borrowings and also to interest rate changes on their floating rate loans.
How do they protect themselves?
They actively use derivative instruments, things like principal-only swaps, cross-currency and interest rate swaps, forward contracts, basically tools to hedge, to lock in rates and reduce volatility.
So they're actively managing those financial market risks.
Yes, and quite carefully. As of June 30, 2025, their unhedged foreign currency exposure, the bit they haven't covered with derivatives, was just over 2,450 crores.
Is that a lot? What percentage is that?
It represents about 24.36% of their total outstanding foreign currency borrowing. And the key thing here is that this is well within the 40% limit their board has approved.
So disciplined risk management there. They're not letting that exposure run wild.
Exactly. Proactive and controlled.
And just to confirm, their focus segment reporting in Note 3826, still primarily renewable energy.
Absolutely. Their core business is financing renewable energy, RE, and energy efficiency projects. They do have a smaller segment operating solar plants, but the main game is financing.
And all within India.
Yes, operates solely within India. So the picture is clear. It's a growing, well-capitalized lender focused on a vital national sector with proactive risk controls in place.
Right. Let's shift now to some of those finer details, the disclosures that add extra color and context, things you might miss just skimming. Note 1, material accounting policies. Anything interesting there?
Yeah, a couple of things show their tailored approach. Take depreciation of property, plant, and equipment, PPE.
Okay.
For their solar power project, they use the straight-line method, but it's specifically based on CERC tariff orders. That's the Central Electricity Regulatory Commission.
So following sector-specific regulations.
Exactly, but then for really small assets, say under 5,000 rupees, or even library books, they just depreciate them 100% in the year they buy them.
Practical approach for minor items.
Right. And it also reiterates their policy on impairment of financial assets.
The loan losses.
Yeah. They use that three-stage model based on credit risk, applying the expected credit loss, or ECL, framework. Standard practice, but good to see it clearly stated.
Okay. Now, digging deeper into the notes, you mentioned regulations earlier. Note 3836 talks about a recent regulatory update. This sounds important.
It is. This is where it gets really interesting for their future operations. There are new RBI directions on project finance coming into effect October 1st, 2025.
New RBI rules. What's changing?
The big change is about provisions for projects during their commissioning phase. So while they're being built but not yet fully operational,
Right.
the new guidelines will require a 1% provision on these projects. That's up significantly from the current 4 to 4%.
Wow. More than double the provision rate during construction. That must have an impact.
It certainly will. It means IREDA will need to set aside more capital as provisions for projects in their pipeline. This will definitely affect their future provisioning calculations and how they allocate capital. It raises important questions about managing capital adequacy going forward.
Something they'll be planning for now, presumably.
Oh, absolutely. They'll need to ensure full compliance by October 1st.
Okay, so that's a future challenge. What about current challenges? Any legal battles or disputes mentioned? Note 3817 on contingent liabilities.
Yes, like any large entity, they have some. These are disclosed as contingent because the outcome and potential liability is uncertain.
What kind of things?
Various bits and pieces, some property tax issues, service tax demands that add up to nearly 250 crores.
That's a decent chunk of change.
It is. And also some GST disputes related to guarantee fees with a potential penalty of over 15 crores flagged as contingent.
Any major specific cases?
There's a notable arbitration proceeding mentioned. It was initiated by a company called Miss Jackson Engineers Ltd. They have a claim against IREDA for about 156 crores related to a solar PV plant project. IREDA, in turn, has filed a counterclaim for about 47 crores.
So a significant dispute there. Shows the kind of complexities they navigate.
Exactly. It's part of the business reality in large project financing.
And finally, the notes even give some quite stark examples of borrower issues, revealing IREDA's response. Note 3851 mentions Ms. Hetero Renewable Energy.
Yeah, that's the case where IREDA actually discovered falsified documents from the borrower related to an offtake agreement. The outstanding loan was relatively small, about 7.8 crores, but finding falsified documents is serious.
Definitely triggers action. And there was another one, Ms. Gensol Engineering GEL. That sounds like a bigger situation, note 3852.
It is much larger and more complex. It started with an interim report from SEBI flagging issues at Gensol.
Securities and Exchange Board of India.
Okay. Following that, IREDA filed a complaint with the Economic Offense Wing, the EOW in Delhi, alleging falsification of documents and misappropriation of funds by Gensol.
Serious allegations. What actions did IREDA take financially?
They invoked guarantees and letters of credit worth about 82 crores, converting those amounts into loan accounts.
Trying to recover what they could.
And then they went further. They initiated corporate insolvency resolution proceedings under the IBC code against GEL for a debt of over 510 crores.
Using the insolvency courts.
Yes. And separately, they also filed for debt recovery of nearly 219 crores against a related company, Gensol EV Lease PVT Ltd.
Wow. That's a compelling example of IREDA actively managing risk and taking strong legal action when things go wrong.
It really is. It shows they aren't passive lenders. They actively pursue recovery and address borrower issues, even complex ones involving alleged fraud. It's crucial for protecting their investment.
Absolutely. Protecting the funds meant for that green transition.
So if we try to connect all these threads, bring it all together, what's the bigger picture here?
What are the key takeaways?
Well, you can clearly see IREDA is growing robustly. Assets are up, lending is up. Their capital position has been significantly boosted by that strategic QIP.
And they seem proactive on risk management.
Very much so. Proactive, disciplined risk management, both financial hedging and dealing with borrower issues, all while navigating, a complex and changing regulatory scene and the inherent legal challenges of this sector.
So hopefully, from this deep dive, you've gained a much more comprehensive, sort of nuanced understanding of where IREDA stands financially and operationally. It's certainly more than you'd get from just a headline number.
Definitely goes beyond the surface level.
So here's a final thought for you to mull over. We know IREDA plays a absolutely central role in bankrolling India's massive renewable energy push.
A critical role.
Given that, and considering the evolving rules like those new RBI provisioning norms, how might IREDA's ongoing efforts managing credit risk, adapting to new regulations, how might that ultimately shape the bigger picture? How could it influence the long-term sustainability and growth of green financing across the entire country?
That's the multi-billion-dollar question, isn't it? Their success and stability could really set the tone.
Something to think about. Thanks for joining us on the Deep Dive.